The first mistake people make with retirement accounts is believing the number on the statement belongs entirely to them. It does not. If you have money sitting in a traditional IRA or 401k, a piece of that account belongs to the Internal Revenue Service. It may not show up on the statement. It may not sit in a separate column. It may not send you a Christmas card, but it is there all the same, patient, silent, and legally entitled to collect. That is why I have always said that numbers by themselves do not make a man rich. What matters is what you get to keep after taxes, after mistakes, after the easy assumptions have been stripped away. Most people spend decades doing exactly what they were told to do. They work, they defer income, they contribute to the company plan, they feel responsible because the account balance rises year after year. They look at the growing total and think they are building freedom. In one sense they are, in another sense, they are building a future tax problem that gets larger every year. It is ignored. The problem does not announce itself when you are 45. It does not knock on the door when you are 57. It waits until the stage of life when people are supposed to feel calmer, and then it arrives wearing the respectable language of required minimum distributions, provisional income formulas, Medicare premium surcharges, and bracket creep. By the time most people understand what happened, they are no longer making a choice. They are reacting to a bill. That is why this particular window matters. Between 2025 and 2028, there is a temporary stretch of years in which many retirees age 65 and older can use a new deduction created by the 2025 tax changes to lower the cost of moving money out of traditional retirement accounts and into Roth accounts. The deduction does not last forever. It does not sit there for your convenience. It disappears after 2028 unless Congress decides to extend it. And I would not build my family's financial life on the hope that politicians keep a temporary gift in place just because it would be helpful. I prefer to act while the door is open. If you want the blunt version, here it is. A Roth conversion is not magic. It is not free money. It is not a trick for the wealthy. It is simply a decision to pay tax on retirement money. Now, on your terms rather than later on the government's terms. That is all it is. And that is precisely why it can be so powerful. When I was younger, I learned that a great many fortunes are not built by doing something complicated. They are built by noticing where control sits, then shifting that control 1 inch in your favor and letting time magnify the result. This is one of those cases people hear the phrase Roth conversion and immediately imagine some exotic maneuver meant for people with private jets and trust departments. That is nonsense. If you have a decent-sized traditional IRA or an old 401k and you expect required withdrawals later in life to stack on top of Social Security and possibly pension income, then the question is not whether the issue applies to you. The question is whether you are going to face it early with a pencil in your hand or late with the IRS forcing the schedule. The tax code is full of moments like this. The public talks about them as if they are technical details. They are not technical details. They are forked roads. Go one direction, and you quietly keep more of what you built. Go the other, and you hand away a larger slice of it because you never stop to run the arithmetic. I have met a great many intelligent people who made enormous sums of money and still lost the tax game in retirement because they kept thinking like accumulators long after the accumulation phase had ended. Accumulating and extracting are two different disciplines. In the accumulation years, the central habit is simple: put money away, delay gratification, let compounding do its work. In the distribution years, the central habit changes. You must think about sequence. You must think about brackets. You must think about what one additional dollar of income does to the taxation of another dollar. You must think about how a withdrawal that looks harmless on paper can cause a Social Security tax surprise, an IRA surcharge, or a jump into a bracket that makes the next few years more expensive than they needed to be. Retirement in tax terms is not one event. It is a series of doors. Some open quietly, some close quietly, and some close so quietly that people do not notice until they discover they have trapped themselves in a room they no longer like. The temporary deduction available from 2025 through 2028 is one of those doors. A married couple, both over 65, may be able to stack the regular standard deduction, the existing age-based extra deduction, and this new temporary age 65 plus deduction in the right circumstances. That creates a much wider tax-free or low-tax corridor than they had before. If their other income is modest in those years, especially before required minimum distributions begin, and before every stream of retirement income is fully turned on, they may be able to move a meaningful amount from traditional accounts into a Roth at a cost far below what that same move would cost later. The important phrase there is "in the right circumstances." I am not telling you to convert everything. I am telling you that most people have never even examined the possibility with real numbers. That is negligence disguised as caution. Let me explain the heart of the issue, the way I would explain it to a family sitting across the table from me. A traditional retirement account is a partnership with deferred taxation. You got a deduction or tax deferral when the money went in. The money grew without annual taxation while it stayed there. That sounds marvelous, and in many cases it is marvelous for a very long time. But deferred is not forgiven. That little distinction has cost retirees a tremendous amount of money. When people are working, deferral often feels like a victory because current taxable income drops. A man contributing to his 401k at 50 is usually thinking about this year's paycheck, this year's bracket, this year's bracket, this year's savings. He is not picturing what happens when the account doubles, then doubles again, then arrives in his 70s, swollen with gains and subject to mandatory withdrawals, whether he needs the cash or not. But the IRS is picturing it. That is their job. A tax-deferred dollar is like a seed planted on land that you do not fully own. If the seed grows into an oak tree, the tax claim grows right along with it in your 40s. The deferred tax may feel small in your 70s. After a decade or two of compounding, that same deferred tax becomes a much larger creature. People understand compounding when it helps them. They forget compounding when it builds the government. That's conversion dollars is very simple. It takes some of that future claim and settles it. Now you move money from the traditional account to a Roth account. The amount moved is treated as taxable income in the year of conversion. You pay the tax, but once the money is inside the Roth, future growth can escape taxation altogether, and there are no required minimum distributions during your lifetime. That last point matters more than people realize. No required minimum distributions means no forced taxable income from that bucket when you reach your 70s. It means more control. It means more flexibility. It means your future tax return has one less machine feeding income into it automatically. It means less chance that your own savings will push more of your Social Security into the taxable zone or shove your Medicare premiums into a higher bracket through IRA. People often say, "Why would I volunteer to pay taxes now?" That question sounds intelligent, but it is incomplete. The real question is this: at what tax rate am I paying now? And at what effective tax rate will I pay later if I do nothing? That is the only question that matters. The tax code does not care about slogans. It responds to arithmetic. A retiree who converts at 12% now to avoid paying an effective 22, 24, or even higher combined rate later has not made a sacrifice. He has bought optionality. Optionality is one of the finest assets in finance. When you have it, you can decide. When you do not have it, the decision gets made for you. That is the trap many retirees walk into. They defer and defer and defer, not because it is optimal, but because they confuse postponement with prudence. Then age 73 arrives, or 75. If they were born in 1960 or later, required minimum distributions begin. The account balance is larger than it was. The life expectancy factor is smaller each year. The withdrawals become mandatory. They stack on top of Social Security. They may stack on top of pensions. They may stack on top of investment income. Suddenly, the retiree is not enjoying low-income years. He is living inside a forced income machine, and the irony is beautiful in a dark sort of way. The very account he built to feel secure is now the account making his taxes less efficient. That is why the years before required minimum distributions are so valuable. I call them decision years. Many people call them gap years. Whatever name you use, they matter because income is often lower than it will be later. Salary has stopped. Social Security may not have started yet, or it may have started at a lower level than later. Required minimum distributions are not yet on the scene. The retiree has room. Room is valuable. Room is where planning lies. If a married couple can look at their tax picture in one of those years and say, we have this much income, these deductions, and therefore this much space before we hit the next bracket or a Medicare threshold, then they can convert into that space, not wildly, not emotionally, not based on a YouTube slogan, based on numbers. That is how grown people handle taxes. They do not guess. They allocate. The temporary deduction from 2025 through 2028 widens that room for many people over 65. It is not the only thing that matters, but it is a meaningful piece of the picture. For some couples, stacked together with the standard deduction and the regular age-based additions, it can create a surprisingly large amount of gross income that gets absorbed before real federal tax pain begins. For some, that may mean a modest conversion. For others, it may mean a substantial one. The answer depends on account size, other income, state taxes, Social Security timing, Medicare exposure, and life expectancy assumptions. That is why I dislike rule of thumb financial theater. The internet is full of loud people telling everybody to convert everything or convert nothing. That is the language of show business. Not capital allocation. The better approach is calmer. You start by asking how large the tax bomb is likely to become if left untouched. If a person has $300,000 in a traditional IRA, that is one case. If he has $800,000, that is another. If he has $1.5 million in a pension, that is another. Still, then you ask how many runway years remain before required minimum distributions begin. 10 years is one sort of opportunity, 3 years is another. Then you ask what else is already on the tax return. Then you ask how much room exists in the current bracket. Then you ask whether an additional conversion risks making Social Security more taxable or triggering Medicare surcharges 2 years later. The people who do this properly are not chasing brilliance. They are trying to avoid stupidity. Avoiding stupidity over long periods is an excellent way to get rich and stay rich. I learned long ago that one of the most expensive sentences in finance is this one: I will deal with it later. Later is where many fortunes go to become tax inefficient. There is another point that deserves more attention than it usually gets. If you do a Roth conversion and pay the tax using money from the IRA itself, you are reducing the amount that makes it into the Roth. In many cases, that blunts the benefit. Paying the tax from funds outside the IRA is usually far more powerful because it leaves more money inside the Roth to compound tax. That means liquid cash outside retirement accounts is not just convenience money, it is strategic money. It gives you the ability to execute when opportunities like this appear. People who keep some cash outside the system are often accused of being too conservative. Sometimes they are simply preparing to make intelligent moves when the timing is favorable. This window is one of those moments, and timing and tax planning is often everything. A Roth conversion done in the wrong year can be clumsy, it can spill into a higher bracket, it can make more of your benefits taxable. It can produce an Irma surprise that shows up later in the form of higher Medicare premiums. It can turn a good idea into an unnecessarily expensive one. A Roth conversion done in the right year, in the right amount, can reshape the rest of retirement. That is not an exaggeration. Take a simple example. Suppose a couple retires, both over 65, with moderate living expenses, some cash savings, and a meaningful traditional IRA balance. In the first few years after leaving work, their taxable income falls because paychecks disappear. They have room. They use part of that room each year to shift money into a Roth, staying below the line that would make the next dollar much more expensive. They do not try to win the whole game in 1 year. They just keep filling the low-cost bucket until the window narrows. What happens later, required minimum distributions are lower because the traditional account is smaller. Future taxable income may be lower because the account feeding mandatory withdrawals is smaller. The Roth keeps growing without required distributions. If markets recover after a downturn, that recovered growth happens inside the Roth, not the traditional account. If they need money later, they have another bucket to draw from. That does not necessarily worsen the tax picture. That is what intelligent planning looks like. It does not look dramatic in the moment. It looks obvious 10 years later. There is another kind of irony here that amuses me. Many people who say they do not want to pay taxes now are perfectly willing to create a much larger tax bill later. They are not avoiding pain. They are postponing it until it becomes less manageable. This is common human behavior. We all prefer the future to absorb costs because the future feels abstract. But the future eventually becomes the present, and then the abstract bill is suddenly sitting on the kitchen table. One of the reasons I have always admired tax-efficient compounding is that it respects reality. The market will do what it does. Congress will do what it does. Inflation will do what it does. My job is not to control those things. My job is to place capital where the odds are better and the frictions are lower. Taxes are friction. Unplanned taxes are often needless friction. The early retirement years are unusually precious because they offer something rare in adult financial life, a temporary imbalance in your favor. You have less earned income, you may still have healthy years ahead, you can still decide how much taxable income to manufacture. And in this particular period, thanks to the temporary deduction, some people have a wider lane than they realize, but lanes close. That is what makes this important. The window closes after 2028 unless lawmakers extend it. I do not invest on hope. I invest on what is in front of me. Now, a prudent person planning retirement taxes today should assume the window is real, limited, and worth evaluating immediately. I say evaluating because thoughtless action is no better than thoughtless inaction. You need to know your starting point. How large is the traditional account? When do required minimum distributions start for you? What is your current expected taxable income this year? What is your current tax bracket? What amount could you convert without jumping into an outcome you dislike? How does that affect Social Security taxation? How does it affect Medicare premiums? 2 years later, how much tax can you pay from non-retirement assets? What will happen if you do nothing? That last question is especially important because doing nothing is not neutral. Doing nothing is an active decision with future consequences. In investing, people sometimes think in only two categories, action and patience. They forget the third category. Neglect looks like patience when the market is calm. It looks like regret when the bill comes due. A great many retirees are neglecting this issue simply because nobody ever explained the structure clearly. They hear the words Roth conversion. They imagine complexity. They postpone. That is understandable. It is also expensive. The tax system punishes vagueness. If you are in your mid-60s or early 70s, this is not the moment to remain vague about where your future taxable income is coming from. The years pass, the account grows or fluctuates, the deduction window gets shorter, the runway toward required minimum distributions shrinks. Meanwhile, the retiree tells himself he will look into it after summer or after the holidays or after the market settles down. The market will never settle down enough to rescue laziness. Discipline must do that work. There is also the matter of heirs, which many people underweight. A Roth is not only about your own lifetime tax management. It can also be about what kind of account you leave behind. Traditional accounts carry embedded tax obligations. Roth assets can offer your family a cleaner inheritance profile. I do not believe in making every decision for the heirs, but I do believe in not handing them unnecessary tax friction if a reasonable strategy could reduce it in advance. Families are often surprised by how much pain can be avoided by 1 decade of disciplined bracket-aware planning. The opposite is also true. Families are often shocked by how much tax confusion and forced withdrawal pressure can be created by 1 decade of drifting. Drift is expensive. It is expensive in markets, it is expensive in marriage, it is expensive in taxes. Every time I have seen a family improve its outcome meaningfully, one habit was always present. They became specific about the balance. specific about the deadline, specific about the bracket, specific about the goal, specific about what amount to move and what amount to leave alone. We live in a world that rewards loud certainty, but actual wealth management tends to reward something else: calm specificity. If this were my money and I had a meaningful traditional IRA balance, and I was 65 or older, and I had a temporary deduction widening my low-tax conversion lane through 2028, I would not be asking whether the topic sounded fashionable. I would be sitting down this week with real numbers and seeing how much of my future tax bomb I could diffuse at a favorable rate while the law still allowed it. That is the whole game. Not emotion, not ideology, not internet bravado, just arithmetic and time. There is one more misunderstanding worth killing before we finish. Some people hear that you can do conversions during the window and assume the right move is to swing hard all at once. That is often foolish. Retirement tax planning is not a chess beating contest. It is a series of annual decisions. You may convert a little in one year, more in another, less in a third, depending on markets, deductions, income, and bracket limits. Sometimes the intelligent move is steady. Sometimes the intelligent move is opportunistic, especially if markets drop and you can convert depressed values into a Roth, letting the eventual recovery occur in the tax-free bucket. Lower prices can make conversions more attractive because you are paying tax on a smaller number of dollars for the same underlying assets. That kind of thinking is what separates owners from passengers. Passengers experience the tax system, owners position within it. And that brings me back to the deepest point in this whole discussion. The retirement account is not the finished product. It is raw material. Most people treat the statement balance as the destination. It is not the destination. It is a pool of future purchasing power that still has to pass through a tax structure. The shape of that structure determines how much of the pool becomes yours to spend, yours to preserve, and yours to pass on. A man who thinks only in pre-tax dollars is still only halfway through the problem. A man who thinks in after-tax flexibility is much closer to actual freedom. Real freedom is not the size of the account. It is the degree of control you retain over what comes out of it, when it comes out, and what it costs when it does. That is why this small temporary window matters so much. It gives some retirees something they do not usually get from the tax code: leverage against their future self-inflicted tax pressure. I use the phrase self-inflicted carefully. I do not mean immoral. I do not mean foolish in the original saving years. I mean unexamined. What begins as wise deferral can become unwise passivity if nobody revisits the structure when circumstances change. Circumstances have changed. The deduction exists now. The window exists now. The years are moving now. And if you let the period pass without examining it, the cost will not appear as a dramatic headline. It will appear as a lifetime of slightly higher taxes, slightly more taxable Social Security, slightly higher Medicare premiums, slightly larger required withdrawals, and slightly less control over your own spending. That is how wealth leaks away in retirement, not through one cinematic mistake, through years of unattended friction. I have never minded paying a fair tax bill. I have always minded paying a needlessly large one. Those are different things. If you are in the age range where this deduction applies, and you have pre-tax retirement money, and you have not yet mapped out what required minimum distributions are likely to do to your future return, then this is not one of those pleasant topics you can leave for a rainy afternoon. This is a live decision. You do not have to convert everything. You do not have to convert aggressively. You do have to understand what is sitting in front of you, because after 2028, the lane narrows. And once it narrows, you will not get those years back. That is the cruelty of tax windows. They do not apologize after they close. They simply disappear. If I were speaking to someone I cared about, I would say it this way: do not wait until the IRS begins dictating withdrawals from a bloated traditional account and then act surprised that the tax bill is larger than you imagined. Do not wait until Medicare premiums jump and then ask why nobody warned you. Do not wait until 85% of your Social Security becomes taxable and then wonder where the low tax years went. Count backward from the age when the government begins forcing money out. Look at the years between here and there. Look hard at 2025, through 2028. Then decide with a cool head and a sharp pencil how much of that future problem you want to solve while the price of solving it is still lower. That is not a trick. That is not politics. That is simply what prudent people do when the numbers are in front of them. And prudent people, over a long lifetime, tend to keep more of what they build.